Krystal, what are you taking a look at?
Well, guys, yesterday in the wake of the second largest bank failure in history, we told you that so far the collapse doesn't appear to be causing a larger contagion, but that didn't mean there weren't still warning signs on the horizon. Specifically, Warren Buffett's business partner, Charlie Munger, is sounding the alarm over the U.S. commercial property market. A lot of real estate isn't so good anymore, Munger said. We have a lot of troubled office buildings, a lot of troubled shopping centers, a lot of troubled other properties. There's a lot of agony out there. This was an interview with the Financial Times. He went on to say American banks were, quote, full of bad loans due to the decline of that market. That got me wondering, just how bad could it be? And the answer looks, frankly, pretty calamitous. In fact, a recent report from Morgan Stanley warns that the commercial real estate crash could put the 2008 housing crash to shame. That report points to three factors that are combining right now to decimate that market. First, COVID dramatically accelerated a remote or hybrid work trend, which has left many office parks virtual ghost towns. In the faraway distant land of 2018, less than 6% of the workforce was remote. Today, that number stands at 26%, so more than a quarter of the nation's workers are fully remote. What's more, 66% of employees work from home at least some of the time. This is an extraordinary sea change in how we do business, which obviously has dramatic repercussions for office needs. What's being described as an office apocalypse has meant that less than half of all offices are currently occupied. That is compared to 95% occupancy rate pre-pandemic. Just think of Amazon spiking their big plans for HQ2 in Northern Virginia due to the tech downturn and the work remote revolution. Think of all those downtowns that have emptied out as office workers stay home or put in only a couple of days at the office. What is the value of that idle vacant office space, which for logistical and often zoning reasons is not really convertible to anything else, at least not easily? Second, just as the Fed's interest rate hikes have spiked mortgage rates, putting a freeze on the housing market, that same dynamic is also spiking rates for commercial real estate as well. And this comes at the worst possible time due to the third factor mentioned in the Morgan Stanley analysis. The entire sector is facing what's being described as a refinancing wall, wherein more than half of the $2.9 trillion market is set to come due by the end of 2025. That is just around the corner, when borrowers, already hobbled by remote work trends, go to refinance and find themselves hit with multi-point higher mortgage rates. How are they going to swing it? Many will not. That is the bottom line, and plenty could default before they even get to that point. Needless to say, when you're talking about a $1.5 trillion wall of debt, it is no small matter. In fact, analysts are predicting that office and retail property valuations could plummet by 40%. And as if looming massive defaults and 40% drop in valuations isn't bad enough, 70% of that debt is held by banks. So going back to Munger's dire warning here about banks holding a lot of bad loans, if anything, he understates the case. And it's not just any banks that are up to their eyeballs in very shaky real estate loans. It's specifically small and medium-sized banks, which account for some 80% of this type of lending. These banks have already been put on shaky ground by the depositor flight to giants like JP Chase. How many will be sent over a cliff when we run face first into that $1.5 trillion wall of debt? Now, like Signature, Silicon Valley Bank, and First Republic, banks with a lot of commercial real estate loans on their books are subject to a lot of interest rate risk. So as the Fed continues to hike rates in what has been an extraordinary death march to strangle workers and crush wages, they could well be tightening the noose around the necks of many more small and medium-sized banks who will face a reckoning over just the next few years. And sure enough, the Fed is meeting again this week to consider their next steps. Now, they've already engaged in the most aggressive program of rate hikes in 4 decades, ever since the Volcker era. They are expected to continue hiking rates. This time, a quarter-point rate rise is expected. What happens after that meeting is really anyone's guess. Some Fed officials believe that rate hikes should continue to be hiked, should continue aggressively, consequences to workers and to the economy be damned. Others are ready to press pause. Meanwhile, 2/3 of economists view a recession as likely. The rate hikes have already started to break things in the economy and in the banking sector. No one should have any confidence that they actually know what's going to happen if they continue down this path. So that's basically the landscape. Not very pretty. Wall of debt made more crushing by rising rates, with a new post-pandemic reality that is not going back anytime soon, if ever. And as we approach this reckoning, having watched what happened with Silicon Valley Bank, we now know the federal government effectively considers all banks too big to fail. How many bailouts might we be on the hook for as they desperately scramble to sell off the pieces in a collapse? How much more gigantic will the big boys and especially JP Morgan Chase become? What sort of contagion could result from a more widespread banking crisis? And how much socialism for the rich is the American public really willing to accept? As I dug into these numbers, Sagar, as a little sort of casual comment from Charlie Munger, it looks really bad.
Yeah.
Hey guys, ready or not, 2024 is fully upon us now, and Sagar and I have been brainstorming ways that we can really up our game for this critical election.
Yeah, we rely on our premium subs to expand our coverage, to add staff, to upgrade the studio. We just want to give you the best independent coverage of this election, which is possible. So if you can help us out, become a premium subscriber today, breakingpoints.com, or the link is down here in the description video. It really means the world to us, and if you like what we're all about, this is the best possible way to keep us 100% independent, working only for you.